I'm reading the book Capital Ideas by Peter Bernstein, The Improbable Origins of a Modern Wall Street. The book has been a great inspiration to me when I just started working on Wall Street 25 years ago. I enjoyed reading it. The ideas, the thoughts are so great, and I liked it very much. Of course, the ideas are kind of idealistic. And 2008, the financial depression has indicated that many of the ideas may be too ideal. And there are some new theories since then. However, still, it tells a major part of the financial market. You cannot use the new theories only and ignore this part of the financial research. For financial research, I want to apply my own theory, which is based on quantum mechanics. That is, the financial market has a multi phases simultaneously exercising their power, their influence. But anyway, I don't want to talk too much before I read this one. I may make some comments while I'm reading this book. I haven't read it for some time. That's why I want to reread it. It is a great book. I don't want to forget it. And I still want to refresh my memory. So, first introduction, the revolution in the wealth of nations. Americans have always welcomed change. Revolution is our birthright. We take it as a sign of our youth that we prefer the new to the old. We are fascinated by innovation and lionize the innovators. We are partial to thinkers and make folk heroes after people like Thomas Edison, Henry Ford, and Benjamin Franklin. I want to make a comment that these days, Elon Musk is the superhero that we know. He's a great innovator. Other people, maybe Steve Jobs is also one of them, but definitely not Bezos. He is not an innovator. He's not an innovator in my opinion. Anyway, it just tells us that America indeed is very partial to the innovators. We love them. We make a hero after of these people. Okay, let me continue. But sometimes change seems to run amok and things appear to be out of control. Then fear takes over and spoils our appetite for novelty. That is what has happened in Wall Street over the past 15 or 20 years. The complexity and speed of financial innovation have reached a point where it is hard to grasp what is happening from moment to moment. Amateur investors and many professionals are wary of space, age, trading strategies, and kinky financial instruments that seem beyond their understanding. Individual investors grumble that they are the last to receive information about the stocks they own and the last to find buyers when security prices are dropping. Giant financial institutions complain that the security prices are dangerously volatile. There is a widely held perception that overpaid MBAs, corporate readers, and investment managers who talk like astrophysicists are living in a world of their own, detached from the realities of people who really work for a living. But that's only part of the story. The untold part, which is what this book is about, reveals that much of this fear and resentment is misplaced. Baffling as it may be to some, Wall Street is vital and productive, a model for the rest of the world, including former socialist countries seeking the path to prosperity and freedom. The gap in understanding between insiders and outsiders in Wall Street has developed because today's financial markets are the result of a recent but obscure revolution that took root in the grooves of Ivy rather than in the canyons of Lower Manhattan. Its heroes were a tiny contingent of scholars, most at the very beginning of their careers, who had no direct interest in the stock market and whose analysis of the economics of finance began at high levels of abstraction. I want to make a comment here that just because the modern financial theory starts from the Ivy Tower by the people who just started doing their academic research rather than from the real financial market, the theory is indeed has indeed focused only on one particular aspect of the financial market, and that's also the reason that it went wrong during the 2008 financial crisis, and it has the tendency to go wrong any moment because of that. Okay, let me continue. Yet the message they brought to Wall Street was a simplicity itself, based on two of the most basic laws of economics. There can be no reward without risk, and gaining an advantage over skilled and knowledgeable competitors in a free market is extraordinarily difficult. By combining the linkage between risk and reward with the combative nature of the free market, these academics brought new insights into what Wall Street is all about and devised new methods for investors to manage their capital. Much of what these scholars had to say often seemed strange and uninviting to hungry investors and to the aggressive salesmen who inhabit Wall Street. But in their quiet way, the academics eventually overcame the old guard and liberated the city of capital. Before they were done, they had transformed today's wealth of nations and the lives of all of us as citizens, savers, and breadwinners. Today, investors are more keenly aware of risk and better able to deal with it than at any time in the past. They have a more sophisticated understanding of how financial markets behave and are capable of using to advantage the vast array of new vehicles and new trading strategies specifically tailored to their needs. Innovative techniques of cooperative finance have led to more careful evaluation of corporate wealth and more effective allocation of capital. The financial restructuring of the 1980s created novel solutions to the problems arising from the separation of ownership and control and made corporate managers more responsive to the interests of shareholders. The first signs of the revolution in finance and investing appeared in October 1974, with the culmination of the worst bear market in common stocks since the Great Crash of 1929. By the time prices finally touched the bottom, market values had fallen more than 40% from what they had been 2 years earlier. That was not all. Overheated domestic economy and the rapacity of the OPEC countries had sent inflation soaring. In just a year and a half, the cost of living jumped 20%, more than 1% a month, after adjustment for inflation. the entire rise in stock price since 1954 had been erased. At the same time, the bond market, the traditional haven for the risk-averse, suffered a 35% loss of purchasing power. No one emerged unscathed. Employees found that the decline in the value of their pension funds threatened the security of their retirement. The stress brought pressure for change throughout the world of finance. The way professionals manage their clients' capital, the structure of the financial system itself, the functioning of the markets, the range of investment choices available to savers, and the role of finance in the profitability and the competitiveness of American companies. Many of the star portfolio managers of the go-go years of the 1960s disappeared in the rubble, along with Richard Nixon's price controls and Gerald Ford's win buttons. Respected banks, major industrial corporations, and even the city of New York stood at the brink of a bankruptcy. Had it not been for the crisis of 1974, few financial practitioners would have paid attention to the ideas that had been stirring in the Ivy Towers for some 20 years. But when it turned out that improvised strategies to beat the market served only to jeopardize their clients' interests, practitioners realized that they had to change their ways. Reluctantly, they began to show interest in converting the abstract ideas of the academics into methods to control risk and to staunch the losses their clients were suffering. This was the motivating force of the revolution that shaped the new Wall Street. Even an incomplete list of innovations that have emerged since the mid-1970s reminds us of how profoundly the present differs from the past. The unfamiliarity of some of the new terminology suggests the magnitude of that break with tradition. Today, there are money market funds, bank CDs for small savers, unregulated brokerage commissions, and discount brokers. There are hundreds of mutual funds specializing in big stocks, small stocks, emerging growth stocks, treasury bonds, junk bonds, index funds, government-guaranteed mortgages, and in international stocks and bonds from all around the world. There is ERISA, E-R-I-S-A, to regulate corporate pension funds, and there are employee savings plans that enable employees to manage their own pension funds. There are markets for options, puts and calls, and markets for futures, and markets for options on futures. There is program trading, index arbitrage, and risk arbitrage. There are managers who provide portfolio insurance and managers who offer something called tactical asset allocation. There are butterfly swaps and synthetic equity. Corporations finance themselves with convertible bonds, zero coupon bonds, bonds that pay interest by promising to pay more interest later on, and the bonds that give their owners the unconditional right to receive their money back before the bonds come due. The world's total capital markets of stocks, bonds, and cash had ballooned from only $2 trillion in 1969 to more than $22 trillion by the end of 1990. The market for stocks alone had soared from $300 billion to $5.5 trillion. Today, more than half of the global market, nearly $12 trillion, trades outside of the United States, compared to only one-third of the market in 1969, hence the wealth of nations. Over $2 trillion, more than 50% of the common stock outstanding in the United States, is now owned by pension funds, mutual funds, educational endowments, and charitable foundations, compared with 40% in 1980 and less than 15% in 1950. These institutions account for 80% of all trading activity in the stock market, and none of them pays income taxes or taxes on capital gains. More than 70% of all outstanding shares changes hands in the course of a year, up from only 20% or so in the 1970s. The average transaction of the New York Stock Exchange now exceeds 2,000 shares, nearly 6 times what it was in 1974. Half of the daily volume of trading takes place in blocks of 10,000 shares or more. Meanwhile, individual investors who buy and sell for their own accounts are a disappearing breed. Their direct holdings of common stocks now represent only 16% of their financial assets, down from 44% in the late 1960s. Other lots transactions of less than 100 shares have fallen from 5% of total volume to less than 2%. Financial assets now change hands with dazzling speed. Daily trading on the New York Stock Exchange averaged over 150 million shares, more than 10 times the daily average of 1974, 5 times the average in the highest year of the 1970s, and 100 times the average in the early 1950s. On Black Monday of October 1987, 604 million shares were traded. Millions of additional shares are traded directly across computers, bypassing the organized exchange altogether. The volume of shares traded in the markets for futures and options often exceeds the volume traded on the organized exchanges. Trading in Tokyo is 10 times what it was in 1982, in Frankfurt 12 times, and in London 30 times. The pace is even swifter in the once sedated bond market. Daily trading in U.S. government bonds runs about $100 billion. That means that the ownership of the entire national debt is turning over 10 times a year. Trading is swifter still in the foreign exchange markets. Transactions in the United States exceed $100 billion a day, while Tokyo does some $30 billion, and other world markets do another $100 billion. Such volume would be impossible without the computer. Many complex securities could not even be priced without the computer's speed and the mathematical capabilities. So-called DOT transactions automate small trades on the New York Stock Exchange and transmit them instantaneously from the customer's broker to the post where the order is executed. The whole world, it seems, is becoming computerized. Even Latin America and Spain rely on computers to carry out trades, check customer credits, and post the transaction results for records and statements. In an article titled "The Wild Weird World of Electronic Exchanges," Institutional Investor magazines for September 1989 paints the scene. Say goodbye to the heady roar of the exchange floor. Forget the terse shouting of two traders on the phone. The new sound of finance is the machine gun clatter of fingers on a keyboard, and it can already be heard on thousands of trading desks in dozens of markets around the world. Financial markets are among the most dazzling creation of the modern world. Popular histories of financial markets, from the City of London to Wall Street, tell the story of panics, robber barons, crooks, and rags to riches tycoons. But such colorful tales give little hint of the seriousness of the business that goes on in those markets. John Maynard Keynes once remarked that the stock market is little more than a beauty contest and a curse to capitalism. And yet, no nation that has abandoned socialism for capitalism considers the job complete until it has a functioning financial market. Simply put, Wall Street shapes Main Street. It transforms factories, department stores, banking assets, film producers, machinery, soft drink bottlers, and power lines into something that can be easily convertible into money and into vehicle for diversifying risks. It converts such entities into assets that you can trade with anonymous buyers or sellers. It makes hard assets liquid, and it puts a price on those assets that promises that they will be put to their most productive uses. Wall Street also changes the character of the assets themselves. It has never been a place where people merely exchange money for stocks, bonds, and mortgages. Wall Street is a focal point where individuals, businesses, and even entire economies anticipate the future. The daily movement of security prices reveal how confident people are in their expectations, what time horizons they envisage, and what hopes and fears they are communicating to one another. The ancients left a prediction to the Sphinx, to the Delphic oracle, or to those who could read the entrails of animals. Achelesius tells us that there is no remembrance of things past, neither shall there be remembrance of things to come. Dante reserved a seat in hell for anyone whose glance too far before him ranged, and twisted their heads back to front. Today, anticipating the future is a necessity, not an arcane game. Yet, how do we make decisions when our crystal ball turns cloudy? How much risk can we afford to take? How can we tell how big the risk actually is? How long can we afford to wait to discover whether our bets are going to pay off? The innovations triggered by the revolution in finance and investing provide answers to such questions. They help investors deal with uncertainty. They provide benchmarks for determining whether expectations are realistic or fanciful, and whether risk makes sense or are foolish. They establish norms for determining how well a market is accommodating the needs of its participants. They have reformulated such familiar concepts as risks, return, diversification, insurance, and debt. Moreover, they have quantified those concepts and have suggested new ways of employing them and combining them for optimal results. Finally, they have added a measure of science to the art of cooperative finance. Okay, let me stop here, and we will read the introduction again later for the remaining part.